Hello everybody, Tortoise Investing coming at you today. It's Monday. Today we are going to be taking a look at two credit rating companies that are very popular, especially among the quote-unquote super investors, and one of these are actually held by Warren Buffett, the king himself. Now, before I jump into that, guys, we're sitting at 131. If you are new, please hit that subscribe button. I would greatly appreciate it. I do 3 uploads a week, and at the end of the week, I do a portfolio update and let you see how the portfolio's been doing, up, down, all around. I show it off. And, yeah, guys, I'd greatly appreciate it. And comment down below. It can be anything. You can say hi, let me know what you've been buying, or if you have any questions. Now, without further ado, let's go ahead and jump into it. So the two stocks we're going to be looking at today is SPGI and MCO. MCO is Moodys, which is very popular among Warren Buffett. He has been a fan of it for quite a while. So SPGI Global, we are going to take a look here through Qualtrim. They have a free cash flow yield of 2.15%. They have a dividend yield of 0.98%, a payout ratio of 32.55%. So good there. Their revenue looks like it is on a steady increase from 2012. The EBITDA ticking in the right direction. Their free cash flow has been doing good. They took a little bit of a hit, it looks like, last year, which is okay. We did have that recession last year, so it probably messes with some things. Their net income is increasing. EPS looks like it is ticking in the right direction. They do have some debt, but it is a little bit over 10 billion. Their EBITDA is 4.7 billion. No worries there. As always, I like to have, if they have debt, I like it to be less than 3 times their EBITDA. Their dividend looks like it is going up. And shares outstanding, I don't know if they've issued more shares or what, but it does look like they did here. Return on capital employed is really high, minus last year. Again, last year we did have that recession, technical recession, and that does mess with these credit unions quite a bit, but credit ratings. But yeah, things look pretty good. Looks like it is overall a good holding. Let's take a look at the dividend stats here. They've been increasing their dividend for 51 years. Ridiculous. You like to see it, though. Their 3-year growth rate, 5-year, 10-year, looks like it is all above 10%. They've been doing littler hikes here lately, but that's not an issue. So I do believe that they're going to get things back on track. I like SPGI a lot, a whole lot. Now let's take a look at Moodys. This is one of the favorites among Warren Buffett. Free cash flow yield of 2.67%, dividend yield of 1.02%, a payout ratio of 37.6%. So all of this is very manageable. Revenue ticking in the right direction. EBITDA ticking in the right direction for the most part. Free cash flow, very similar to SPGI as you've seen. They did take a little bit of a hit there. Net income is a little bit down in 2022, but for the most part, things seem to be ticking in the right direction, and the dividend, very nice. Now their debt, they have $7 billion in debt, $2.3 billion in EBITDA. So this is in the what I consider the oof zone. Now, the year before that, they did have $3.2 billion EBITDA, which would be more than cover the 3.0 ratio that I like to see. Shares outstanding is continuously going down, and a very consistent return on capital employed of above 20%. It looks like it's very reliable. Let's take a look at their dividend stats here. Moody's has been increasing their dividend for 14 years. Let's look at the dividend growth. 3 years, 11.8%. The 5 years, 19.69%. And the 10 years, 15.2%. It looks like they have consistently been above 10% dividend growth, which, again, you want to see. I like to target stocks that are above 10% or have a very big history of increasing over time and still beating inflation. So very quickly here on bar chart, I have SPGI and Moodys going up against SCHD and VOO. Just kind of a comparison so you can see the growth here. Over the 1 year, everything's pretty tight. Everything is within like 3% of themselves. Yeah, everything's pretty tight there. Let's take a look at the 3 year. The 3 year, it looks like SPGI and SCHD are slightly beating the SP 500. Moodys is down a little. Now the 5 and 10 years where you're gonna see a big difference here. Yeah, SPGI and Moodys looks like it is beating VOO and SCHD by about 30%. And then again, if you go to the 10 year, it gets even wider. So really the question is which one of these do I like the most? And personally, I like SPGI better. The reason being is it looks like their financial sheet's a little bit more balanced. Their revenue, net income, and EPS hasn't taken quite a hit as Moodys has. Because if you look here, the revenue's down, EBITDA's down, where with SPGI, revenue, EBITDA, and net income is all still increasing. They do have this little spike in debt, but again, it covers the 3.0 ratio that I like to keep it inside of, where Moodys does not. So, for that reason, I like SPGI a little bit better than Moodys. If I was to add a financial to my portfolio, I would probably go with this or Visa on another drop. I was originally in Visa, and it shot up on me, and I got out of it. I move around a lot. I can't help it. But SPGI, I like it a lot. Yeah, let me know what you think down below. And if you have any questions, comments, as always, let me know. And until next time, see yous.